The broadcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon and a warm welcome to all. I'm Ridul on behalf of K Ratings. Welcome you to today's webinar on corporate performance Q3 FY 2019. I appreciate your time in joining us for this webinar. Our speakers for today is Kavita, Chacko, Senior Economist at K Ratings. Along with her, we have Darshini, Kansara, Deputy Manager, Industry Research. The discussion is in form of a presentation which is visible on your screen. In case of queries, we'll be having a Q&A session no sooner the presentation ends. In case of any queries, you are please requested to key in the slot provided. May I request Kavita to begin the session?
Thank you, Mridul. Good afternoon, everybody. In our webinar today, we will be having a close look at the overall performance of the Indian corporate sector in the third quarter, as well as for the first 9 months of the current financial year. Here, we have also examined the performance of companies based on size to see if the performance differs across different size groups. In addition to this, we also look at the industry-wise performance of nearly 50 sectors. To begin with, in order to put the current performance in context, the underlying economic scenario is looked into here. The Indian economy last year, especially in the first half, was impacted by GST implementation, and although there was a recovery in the second half, economic growth for the year as a whole was at a 4-year low. There are indications that the economy is on a higher growth path this year, with the operating and economic environment this year being different from last year. The domestic economy grew by 7.6% in the first half of the current fiscal, higher than the 6% growth in the first half of last year. Industrial output growth too in the first 9 months has been higher at 4.7% compared with the growth of 3.7% a year ago. Investments too have seen an improvement this year, but are yet to see a notable pickup. The earnings of corporates was expected to see an improvement this year over last year. Our assessment of the corporate performance for the third quarter and the 9-month period of April to December 18 is based on the performance of 3,400 companies over the comparable period of last year. This includes banks and finance companies. On excluding banks and finance companies, the performance of 2,800 companies has been covered here. All these companies have announced their results on or before 22nd February 2019. The aggregate performance of the 3,400 companies in Q3 FY19 over last year, that is Q3 FY18, shows an improvement in net sales growth being nearly double of that of last year, and net profits too seeing higher positive growth from the negative growth of year ago. In quantitative terms, net sales in Q3 FY19 grew by 16.1% compared with the 8.6% growth during the comparable quarter of last year, and net profits have grown by 13.4% from the minus 0.4% growth of year ago. Net profit margins, however, have remained largely stable at 6% during the quarter gone by. On excluding banks and finance companies, the corporate performance shows a similar trend in terms of growth in net sales. However, net profit growth here shows a moderation. At around 7% in Q3 FY19, net profit growth is 11% lower than the growth witnessed in Q3 FY18. This slowdown in net profits was on the back of the nearly 20% increase in the expenditure in Q3 FY19 vis-a-vis an expenditure growth of 9.8% in Q3 FY18. The growth in expenditure can be ascribed to higher raw material costs as well as energy and employee costs. Among these, the increase in raw material cost has been the highest at 25% when compared with year ago. Power and fuel costs have grown by 17% and employee costs has risen by 11% on a year-on-year basis. Other general expenses grew by about 16% during Q3 FY19, which was nearly 3 times the growth when compared to Q3 FY17. The increase in raw material cost during the quarter is mainly on account of the rise in crude oil prices, which rose by 10.8% on a year-on-year basis. Higher crude oil prices impacted raw material costs for industries such as chemicals, rubber, plastic, textiles, among others. Also, while interest cost accounts for a marginal share in the overall cost, it registered an increase of about 14% during the quarter vis-à-vis a decline of about 6% during the corresponding period of the previous year, putting downward pressure on the net profits. Interest coverage ratio for the sample of 2,800 companies, that is excluding banks and finance companies, was marginally lower at 5.5 times in Q3 FY19 vis-à-vis 5.7 times in Q3 FY18. Coming to the performance for the 9-month period of April to December 2 shows an improvement in net sales and net profit in the current fiscal from year ago. For the total sample of 3,400 companies, net sales have grown by 16.7% versus a growth of about 7.8% during the 9-month period ending December 2017. And net profits have grown by 14% in the current financial year, which is significantly higher from the negative 12.5% growth in the first 9 months of the last fiscal year. Profit margins for the sample, however, have largely remained stable at around 6% this year. The 9-month performance, excluding banks and finance companies, that is of 2,800 companies, too shows an improvement. Net sales witnessed a growth of about 18%, that is 10% higher than the growth in the 9 months of FY18, and net profits have grown by 24.5% compared with the minus 7% growth of last year. The interest coverage ratio for the sample was also marginally higher at 5.4 times during the 9-month period in FY19 vis-à-vis a 5.1 times during the corresponding period of last year. I now request Darshini to take you through the size-wise and industry-wise performance.
Thank you, Kavita ma'am. Moving forward with the size-wise analysis. In this section of the study, we break down the sample of 2,800 companies by size to see if the performance of the companies differs across various size groups. The size groups have been defined on the basis of net sales figures for the third quarter of FY19. Table 5 here gives the composition of the sample differentiated across various size groups for Q3 FY19. The 198 companies in the size range of sales of above rupees 1,000 crore each constituted about 80% of the total sales of the sample companies and dominated the overall performance. The next two size ranges between 100 crores to 1,000 crore have had shares of 7.4% and 8.9% respectively. Therefore, the top 936 companies in terms of sales above rupees 100 crores have accounted for over 97% of the total sales. With the GST impact subsiding, overall industry operations in Q3 FY19 picked up quite markedly. However, companies having net sales lower than rupees 50 crores continued posting net losses during the Q3 of FY17, FY18 and FY19, with the maximum hit felt during Q3 of FY19, where the net loss to the extent of rupees 970 crores was posted. while net loss of companies in the size range less than 10 crore stood at rupees 1,427 crores during Q3 FY19. The top three groups, which is net sales over 100 crores, have witnessed comparatively higher growth in sales in this quarter, while companies below net sales of 100 crores have witnessed a year-on-year decline in net sales vis-a-vis Q3 FY18. These companies with sales above 1000 crore have witnessed the sharpest growth of 19.3% in net sales and clearly dominated the aggregate performance with a share of over 80% in total sales. However, in case of net profits, these companies have registered only a marginal growth of about 2% vis-a-vis a growth of over 20% in Q3 FY18. Companies in the size range between 500 to 1000 crore have registered a year-on-year increase of 11.8% in net sales. Net profits have witnessed a growth of over 200% during the quarter. This high growth is mainly accounted for by a few large companies such as Shoppers Stop, Jubilant Foods DLF Limited, Sun TV Network, GHCL, JK Paper, among others. Interestingly, the size ranges with maximum number of companies, that is, companies below 10 crore net sales, has continued to register net loss in Q3 FY19. To summarize our findings on Sizewise Analysis, the overall performance has been driven by the large companies that accounted for over 80% of the share in terms of total net sales. However, in case of net profits, these companies have registered only a marginal growth of about 2% over a growth of over 20% during the corresponding period last year. While those at the lower end of size scales witnessed lower growth in both sales and profit, with companies below sales of 10 crore witnessing net loss during the period. As can be seen, while the overall picture of the industry has improved post the GST implementation, the smaller companies have continued to be on the back foot and suffer losses. Now coming to the industry-wise analysis, we have looked at industry-wise performance of about 50 industries that can be broadly classified under 10 categories, namely consumer goods, discretionary and non-discretionary, auto and related, capital goods, metals, construction real estate, banking, finance, services, and oil refining and mining. While touching upon sectors, I will be talking about the company performance based on net sales first, followed by performance based on net profits. All industries registered a year-on-year growth during the quarter. Also, a similar trend was seen during the 9-month performance ending December 2018 period. Within consumer goods non-discretionary, except for sugar and tea coffee, all sectors have witnessed positive growth. Sugar industry in the current quarter was in the Q3 FY19 was affected mainly on account of lower sugar prices and surplus sugar inventories in the country. The small scale sugar prices in the country have averaged at about rupees 31 per kg during Q3 FY19, registering a year-on-year decline of about 11.8%. Under consumer goods discretionary, after a slow beginning, the consumer demand for textiles and electronics have improved towards the end of the quarter. Exports, however, have remained under pressure due to stronger rupee against the US dollar, and weak import demand from China. The automobile industry witnessed a slower growth of about 7% in Q3 FY19 vis-a-vis a growth of 11.2% during the same period previous year. This slowdown was also reflected in the overall industrial output growth for the auto segment that witnessed a slower growth of about 2% vis-a-vis a growth of over 18% last year. Despite new launches and facelifts in the passenger vehicle and two-wheeler segment, demand was marginally slow in the country, led by increased insurance, interest, and fuel costs. Also, price hikes by many players kept the demand under pressure. Capital goods witnessed a higher growth of about 15.5% in Q3 FY19 vis-a-vis a growth of 4.6% in Q3 FY18, led by increased sales registered by engineering, electronic components, and telecom equipment players during the quarter. Metals industry grew at a slower pace of 4.8% vis-à-vis a growth of 14.8% last year, led by decline in global prices of various base metals due to the ongoing trade wars between major economies. While steel, iron, and aluminium industry have witnessed year-on-year growth in sales, other non-ferrous metals such as zinc, copper, and lead players have been affected during the quarter. The global aluminium and copper prices have declined by 6.4% and 9.4% respectively during the quarter. Construction real estate industry has done well during the quarter, with net sales registering a double-digit growth of about 16.7% vis-à-vis a growth of 4% in Q3 FY18. The growth was largely driven by higher volume sales registered by cement and ceramic players due to improved demand from the infra and real estate sectors. This is largely in line with the growth witnessed in the domestic cement production as well. The IIP for cement grew by about 12.9% during Q3 FY19 vis-à-vis a growth of about 10.6% during the corresponding period last year. Banking industry witnessed higher sales of about 13.6% vis-à-vis a growth of 6.7% driven by the sharp growth of about 26% witnessed by private banks during this quarter, led by robust growth in loan book vis-à-vis a growth of 9.5% during Q3 FY18. Public sector banks also witnessed a year-on-year growth, though marginal, of about 8% in sales vis-à-vis a growth of about 5.5% in Q3 FY18. Within finance, both housing finance and NBFCs have registered a double-digit growth of about 18 to 20% during the quarter. Bank loans to NBFCs has registered a sharp double-digit growth of about 55% as of December 2018 vis-à-vis a growth of about 14.3% during December 2017, while bank credit to housing segment has witnessed a rise of about 17% as of December 2018 vis-à-vis a growth of about 14% witnessed in December 2017 period. This has resulted in NBFCs witnessing a growth of about 20% in sales during Q3 FY19, with the increasing trend of financialization of savings, better risk management, and tax incentives for the mid-income affordable housing and increase in small-ticket home loans. Service industry registered a sharp double-digit growth of over 18% in Q3 FY19 vis-à-vis a nominal growth of about 1% in Q3 FY18, led by growth in hospitals and healthcare services, retailing, airlines, IT software, and telecom service providers. Hotels, resorts, and restaurant sales growth largely remained stable at about 3.5% during the quarter. All three segments under mining and oil refining, that is, mining and minerals, oil exploration, and refineries, have witnessed strong growth in sales during the quarter, with the sharpest growth of about 28% witnessed in mining and mineral sector. This was followed by net sales of refineries that grew by over 25.4% and oil exploration, where sales witnessed a year-on-year growth of over 20%. Others here include sectors such as agrochemicals, paints, paper and paper products, diamond and jewelry, industrial gases and fuels, among others. Amongst these industries, the highest growth of over 34% was witnessed in the industrial gases and fuel sector, followed by paints industry, registering a growth of about 22%, and glass industry registering a year-on-year growth of about 16% in Q3 FY19. A growth of about 11 to 15% was witnessed in the pesticides and agrochems, plastics, diamond and jewelry, dyes and pigments, and paper products industries. Fertilizer industry sales witnessed slower growth of about 5% in Q3 FY19 vis-à-vis a double-digit growth of 17% in Q3 FY18 on back of deficit northeast monsoons, which impacted the sowings and agri-input consumption in key markets. Sales of rubber products continue to remain largely stable at about 10% during the quarter. Moving on to net profits. In terms of net profits of the 50 major industries, 43 industries have continued to register profits, while 7 industries, namely textiles, consumer durable electronics, telecom equipment, engineering construction, public sector banks, airlines, and telecom service providers, continue to display weak performance, registering net loss during the period, with the highest loss of rupees 11,600 crore posted by public sector banks, followed by a loss of about 5,600 crores posted by telecom service providers and textile industries that registered a net loss of about 1,300 crores during the period. Some industries, such as consumer foods, sugar, electronic components, turned positive on a year on year basis during the Q3 FY19 period. Industries such as tea, coffee, solvent extraction, auto and related industries, mainly passenger cars, two wheelers, tractors, and ancillary, steel and iron products, cement, NBFCs have registered strong growth in profits during the quarter. Here in this slide, we have presented a snapshot on industry-wise performance based on net sales and net profits growth during the 9-month period ending December 2018. As can be seen, a majority of industries fall under the 0 to 20% growth category in both sales and profits, while consumer industries such as tea, coffee, solvent extraction, auto ancillary, NBFCs, rubber and glass products have witnessed growth in sales between 0 to 20% and profits of over 40% during the period. High growth in both sales and profits have been witnessed by auto, trucks and LCVs, aluminium and aluminium products, paper and paper products, and oil exploration during the 9-month FY19 period. The top industries in terms of growth in sales during the 9-month period are industrial gases and fuels, oil exploration, refineries, automobiles, trucks and LCVs, and private banks. To conclude, the growth in Q3 FY19 corporate performance has been driven by large companies that accounted for about 80% of the share in terms of total net sales. However, in case of net profits, these large companies have registered only a marginal growth during the current quarter. Those at the lower end of the size scales have witnessed lower growth in sales, with companies below the sales of rupees 50 crore have witnessed net loss during the period. While the overall aggregate picture of the industry has improved post GST implementation, the smaller companies have continued to be on the back foot and suffer losses. Despite various industries showing signs of recovery in the 9-month FY19 period, the growth momentum is yet to see a noteworthy pickup across segments. Metal prices have continued to remain subdued, and given the geopolitical conditions, there is an upward risk to oil prices, which will have a bearing on the input cost for companies across various sectors such as textiles, chemicals, refineries, oil exploration, rubber, plastic, while the demand for automobile industry also depends on the fuel prices. Therefore, the performance of corporates over the coming few quarters will test the improvements and strength of the recovery in the overall economy. Thank you.
Thank you, Darshini, Kavita. Now we'll be taking a break of 2 minutes before we begin a Q&A session. In case of queries, we are please requested to key in the questions. I repeat, we'll be taking a break of 2 minutes before we begin our Q&A session. Thank you.
Welcome back. We have a question from the line of Mr. Sagar. He's asking, please explain which sectors among mid caps and small caps will do well going forward. Thank you for the question. Amongst mid caps and small caps, we are expecting capital goods, metals, and construction industries to do well in the next few quarters and the coming year as well. There's another question asking for outlook on the auto industry. So, Care Ratings view on the auto industry for FY19, the remaining quarter. We have PV segment growing by about 6 to 8% for the entire year FY19. Commercial vehicles growing at about 25 to 30%. Two and three wheelers growing at 15 to 17%, and tractor industry growing at 15 to 17% as well. For FY20, we have a higher growth rate of about 8 to 10% for the passenger vehicle segments. Commercial vehicles has marginally been moderated at about 20 to 25%. Two and three wheelers has been about 16 to 18% growth, and tractors has been maintained at 15 to 17% growth for FY20. There's a question: what led to the double-digit growth in sales and profit in capital goods sector? Largely the low base of the last year, Q3 FY18 quarter, has supported the double-digit growth. Also, a lot of activity has been taking place in in the capital goods segment. Also, recently we have seen investments have been picking up, namely the public investments have been increasing in the segment, leading to a double-digit growth during the in the capital goods industry. What led to the double digit? Okay, sorry, the question is, what is the specific growth for paint industry and how does the outlook of this industry look like in 2019 with the increased pressures of raw material prices? In Q3 FY19, the paints industry has registered a growth of about a sharp growth of about 22% in the net sales during the current quarter, over a negative growth of about 1.2% in the Q3 FY18 period. Also, in terms of net profits, we have seen a growth of about 9% in the paints industry during the quarter. This was basically, the government push on infra with the affordable housing, taking a front foot, and a lot of disposable income has increased in the economy. So this has been leading the demand for paints industry, and going forward also we are seeing that the demand for paint industry is expected to be upward for FY20. What is the sensitivity of crude oil prices in the growth of economy at an overall level and paints and chemicals specifically? The crude oil prices increase could could impact our deficit, both current account and fiscal deficit. It would have an implication on the value of currency and also pressure inflation and consequently could push the central bank to raise interest rates. In terms of paints and chemical industry, the raw material cost would be pushed up, leading to an overall pressure on the margins of the industry. We have another question. What portion of sales growth was led by volume versus price, and what is the current capacity utilization of industries? The current capacity utilization of all the industries put together stands at about 70 to 75% broadly. Also, we expect for the broader industries, we have consumer goods, automobiles and related, capital goods, construction, and services industry to perform well in the next coming few months. However, textiles, consumer durable electronics, telecom equipment, public sector banks, airlines, engineering construction, and telecom service providers are expected to see a subdued growth going forward. We have one more question. Can we see correction in the housing finance in the near future? Uh, as we have seen in the Q3 FY19, housing finance companies have already registered a sharp 20.7% growth vis-a-vis 14% of last year. So the industry is already performing well. Also, in terms of profits, we have seen the industry marginally suffer. However, with the gradual improvements that the sector is seeing, we expect the industry to normalize in the coming months. What are your views on iron ore and steel prices going forward? Uh, with the mo- with the expected moderation in the global economic conditions, we demand for raw materials is expected to remain subdued, putting a downward pressure on the metal prices. Uh, in the near future, also we expect to continue this trend going forward.
Hi, I think that was the last question taken up for the day. The other unanswered queries probably will try and reply by email. Thank you again for taking up part by being part of this K Ratings webinar, and we look forward to your suggestions and feedbacks in the comment box, which will be coming no sooner the webinar ends. Thank you and goodbye for now.